Hello and welcome to another Trades and Tutorials video. In this video, I am going to take a look at a market indicator that looks pretty grim right now. And when this indicator looks grim, it actually creates a great opportunity to identify a significant market low. But before we get into that specific indicator, let me just make sure that if you're just finding this on YouTube, that you know you can sign up for our channel. Please do. And if you're not seeing this in the trades and tutorials section of our website that you happen to see on our page right here, you can find us at marketgauge.com/tutorials. You can also follow us at MarketGauge and at Market Minute for more trades and analysis. And finally, you can get this video in HD by changing the settings in the lower right-hand corner of the video. All right, so as I just said, I am in the resources section of marketgauge.com because I'm going to show you an indicator here that's one of my favorite indicators for big picture market highs and lows. And I'm actually in the little big view section, which you can find by going to resources, little big view. That'll take you to this page here, but this isn't where I want to focus your attention. I want to focus your attention on the market internals section. All right, so for some of you, this might seem a little technical, and if you're just trading ETFs and not individual stocks, this still works for you too, because as you know, we trade and follow industry groups as well as individual stocks. And so those industry group ETFs would be a great place to look when you see major market turns. And right now, as I create this video, the market's kind of gotten weak in part because the Fed is indicating that it's going to raise rates for the first time in something like 10 years on Wednesday of this week, tomorrow. So the market's a little on edge, not to mention the fact that commodities have been imploding and the high yield market has been imploding. So there's a lot of unknowns out there. So the good reasons for the market to be weak. And so bad news and an ugly indicator can often create an interesting opportunity. And one of my favorite indicators to identify these turns is one that you'll find in this section of our website. It's all free, and it's the new high, new low ratio. And if we just take a look at the chart, what this indicator does is it takes a total number of new 52-week highs and it divides it by the total number by the total sum of new highs and new lows. So in other words, what percentage of stocks that are either making a new high or making a new low are making new highs? And it's really easy to read. And here's what the chart looks like. We look at it for both New York and NASDAQ. And you really want to look at just the big picture, not every single squiggle. And the key levels to follow are the 70% on the upside and the 30% on the downside. So if you have this indicator up over 70%, it means that you've got a lot more new highs than new lows. So that's bullish. It's not an overbought, oversold indicator by any means, all right? However, the interpretation of it is that if you are above 70 and then you come below 70, it means that the market's weakening, all right? And it probably means the market's weakening from a high level. And so that's why you become bearish, or it's a warning when you drop from above 70 to below 70. Now, if you're in a market condition where you've got lots of new highs, and I'll go into more detail in just a minute, you've got lots of new highs and you just dip below 70, that's not going to be a problem. But in this case, as you can see, the market ran up, just got over 70, which isn't very strong, and then starts to roll over. So when it's rolling over, the other thing you want to look at is the trend. If you've got a significant time frame in the trend, then that is going to be slightly bearish. So slightly bearish coming from a market that is coming from the 70 level is something to be concerned about. Now this is a little bit more technical, but look what happened when the market tried to make a new high relative to this. Your new highs did not even come close. So what this is telling you is that even though the market may have rallied back up to the same level, internally it's not as strong. And so then you got to be concerned when it starts to move down again. All right, so where is the ugliness and opportunity? Well, here's a good example of it from September. So in September, and actually before I even get there, let's take a look at the downside. So the same is true in the opposite effect. When you get under 30%, that means your market is really not in good shape. Now, as you can see, the markets were not far off of their highs for 2015 when this was near 20%. So that is not a healthy situation. As the markets consolidated, this really just began to trend and stay low. So during this whole period, this indicator was telling you that while the markets may be holding up, it's not because a lot of stocks are making new highs or strong. It's a warning. All right. Now, one thing you want to see, and this is where it becomes an opportunity, is when markets get really flushed out. When they get really flushed out, you'll trade for a significant amount of time under this 20 level. And then when the markets are churning and bearish, as they were in here, you want to wait for it to come back over the 30 line. Same idea as falling under the 70, only in the opposite direction. All right, so when that happened, we got a corresponding strong move higher. And as you can see, that was accompanied by a strong trend higher in this particular indicator, pushing it all the way up to 70. So if you just keep the analysis that straightforward, what you're looking for is a significant trend to give you a bias, and you're looking for opportunities when the market gets oversold or really pounded. Again, oversold would imply you want to be a buyer down here. That's not the way I would read it. I would wait for the turn and look for momentum. Because it can stay down here for a long period of time in bear markets. It can stay up top for a long period of time in bull markets. That's why I would not look at it as if it gets too high, you're a seller. If it gets too low, you're a buyer. No. All right, you want to see it turn and have that change in momentum. But the opportunity here is that the market has now sold off. It's consolidated for a while. I would have expected the market to be more down in this area with all this little consolidation in here. So we're finally back down, getting back down there. So if the market, and the thing I want you to focus your attention on for the rest of December and into January as well, is that if this turns back up and comes back over the 30 line, that's an indication that the market's getting stronger. And then look at the trend. And like I said, you can get this indicator right at our site, so it's not like you have to buy anything to get it. So here's what it looks like for New York. Now I'm going to go to the chart index just so that I can jump to the NASDAQ more quickly. Now here's NASDAQ right here. Let's take a look at NASDAQ. And you can see that NASDAQ is going along the same lines, right? It's stronger. It hasn't got down to the 20, but it's down in the bearish area, all right? Under 20 is really bearish. You can see, however, that even in August when things fell apart, it just barely got under the 20, got a little worse in here. But coming back up through, that's what we're going to look for. So if the markets turn higher going into January, even right now for the rest of December, the good news is they have gotten pretty washed out, and a turn up could lead to a worthwhile move up. Now, I'm going to show you the newer version of this, which will be out shortly, and I'm showing it to you for two reasons. So here's the same thing except it's in a different chart, and the difference in the chart is that it is also showing the total absolute number of new highs and new lows. And this is another thing you want to watch for as you look at this indicator. You want to see, for example, if the indicator turns higher, let me change to black. If the indicator turns higher here, like it did here, you really want to see these total number of new highs get back up to, say, 100. 100 would be at least healthy. So it's not surprising that while the trend here was up and the market continued to move higher, it's not surprising that it rolled over because we never really got a significant number of new highs. What did happen is the new lows went down and the number of new highs edged up, and so the ratio was good, and that's what you see here. But you also want to look for the absolute number to get higher for a really good bull run that would continue. All right. Now, the other thing that you can see with these new lows, or sorry, with the new lows, which is in red, is you can see when it really does get flushed out, when you really do have a weak day. So when you have under like 500, under 400 new lows, especially if you have it for a prolonged period of time, that can lead to a situation where you get a relief rally in the beginning of a rally. So we did just the other day have a big spike down in new lows. Again, that doesn't mean it's not like an RSI per se. It means it's going to snap back. It does mean, however, that the market has had some real selling, and it's from that real selling that bases can be built and rallies can be built. All right, especially when we're talking about a market that has been consolidating for a year. So we want to see some kind of, not necessarily capitulation, but it's a washout effect. So going forward, I know you can't see this chart on our site yet, but soon you will be able to. But what you can do is on your platform, you can look at the total number of new highs and new lows. And as just an easy number to remember, 100. All right, so if the market starts to turn up, keep an eye on those new highs, that new highs number. You want to see it look like 100, and then you want to see this chart turn up above 30 and be trending higher. If both of those things are in gear, you're going to get a situation that is really friendly to the bulls. Here's, if we just take a quick look at some of the history, I'll show you what that looks like. So in this example, we had a strong sell-off or a really weak sell-off, depending on how you want to look at it, that in October of 2014, you can see the indicator turns positive from under 20 to back over 30, and then you have an explosion of new highs. And when you have that, look at how long, I know it's not a straight up move, but the market continued to grind higher in a much healthier way. And you can see that when the new highs started to get down below 100, that the market really started to make less and less progress. And how that shows up in this indicator is it starts to dwindle down, all right? And you'll see the new lows start to pick up. So all during this consolidation, internally, the market is really telling you, I'm not ready to break out to the upside. In fact, I'm getting sick. So we want to look for something if the markets do turn up and move higher, and the Fed's news out of the way could cause the market to have either a big move up or a big move down. And the question you want to ask yourself is this move real? And this is an indicator that'll help you determine that. Not every single day, but over the course of weeks, this is a great indicator for understanding the underlying strength of the market. So whether you trade ETFs or you trade stocks, it's always good to be on the right side of the market. So I hope that helps, and I'll see you in the next video.